This is part 2 for chapter 4. In part 1, we covered the basis of the market system and why the market system works. Now what we're going to do is examine the components of the market system. We know that in the market system it consists of buyers and sellers, and so that is going to constitute the private sector. Those that are buying the goods are the households, which you see here. Those that are selling the goods are the businesses. And then also we have to include the international sector, because when we buy goods and services, we don't necessarily always buy them from U.S. owned companies. We also buy goods that are produced by firms outside of the United States. Therefore, countries that we trade with are part of our private sector, so we have to include them in our analysis. Now, although our analysis of the market system was basically giving us the argument as to why the government doesn't need to dictate what goods and services are produced, that the market system will be able to do that on its own, we do know that we still have a very active government that plays a crucial role in our economy. So after we've covered the components of the private sector, we will also cover the components of the public sector, which just consists of the government. So the first component of the private sector is the households. Those are the people doing the spending in the economy on goods and services. So that's you and me. Now the reason why we define it as households opposed to families is because households is a broader term. It takes all living arrangements into consideration, which is what we want to do. So by definition, a household consists of one or more people who occupy a unit of housing. So again, you can see this is the most broad term we can use to analyze data for income and what have you in the United States. So again, a family may constitute a household, but a household doesn't necessarily have to be a family. And as of 2010, there was about 117 million households in the United States. You'll notice that I also have a pie chart distribution here, and this is just for illustrative purposes, just to kind of give you a general breakdown of what the average household in the United States looks like at this point. What you can see is that we have very, very small household sizes. The average household size is around 2 people, but if you look at that pie chart and combine the number of 1-person and 2-person households in the United States, that's roughly 60%. So more than half of all households in the United States only have 1 or 2 people living in them. And there's a lot of reasons that contribute to the decreasing household size in the United States. One of them just being economic. In other words, we live in a country where people have the ability to earn income, therefore move out of their parents' house and maintain their own household, where in other countries where those opportunities do not abound, it's very common to see multiple generations living under one roof for the economic reasons. Also in the United States, we have easy access to birth control, so we have the ability to control our birth rates, which allows us to maintain smaller household sizes. Again, in other countries, that may not be the case, or perhaps women don't control their birth rates for religious or cultural reasons. Another factor in the United States is simply the fact that we have had an increase in divorce rates. So where there used to be one larger household size, now it breaks down into 2 smaller household sizes. And then another factor is just that people are living longer. So as people live longer, rather than grandma, grandpa living with, family, it's very common to see elderly live independently on their own, which again increases the number of small household sizes in the United States. Now, when we talk about household spending in the economy, we refer to that as consumption spending. And oftentimes, consumption spending is denoted by the letter C if you're looking at an economic formula. Now, household spending is the largest component of total spending in the economy. It currently constitutes about 70% of all spending in the United States each year. So again, it's crucial to our economic health for households to continue their spending habits. You'll also notice that I have another illustrative graph here showing the relationship between household spending in the U.S. and its relation to income. And of course, what we see is that there's a positive relationship between the two. So all that means is that as our income increases, so does our spending, right? We consume more as we make more money. Now, the second component of the private sector are the business firms. These are the businesses that are actually producing the goods and services that we are purchasing. And a business firm can be organized in three general forms. It can either take the form of a sole proprietorship, a partnership, or a corporation. If it is a sole proprietorship, what that means is there is just one legal owner of the business, and that legal owner is responsible for all the debt that's incurred, and they also get to keep all of the profits that they maintain. So again, for a sole proprietorship, there's just one owner. They maintain all profits, and they are legally responsible for all debt personally. So what this means is, let's say I open a small business and I take out a small business loan, but my business ends up going bankrupt. I go under, which is very common. Most businesses fail within the first 2 years. What that means is that that bank can come after my personal property. They can put liens on my house, liens on my cars, things like that. So that's what we mean when we say that they are personally responsible for all of the debt that they incur. Their creditors can come after their personal property. But of course, if the business is profitable, they get to maintain all of their profits, and those profits are only taxed once as their personal income. Now, a partnership is almost identical to a sole proprietorship. The only thing that makes a difference is there are two or more owners. But again, all of the other rules apply. In other words, they get to maintain all of the profits, but again, they are responsible for all of the debt that the business incurs. But again, what makes it different is there are two or more owners. And as far as a partnership goes, we can talk about two individuals partnering together, or it can actually be two businesses partnering together. Now, the third type of business is the one that is completely different, and that is a corporation. A corporation is a legal entity all on its own, separate from its owners. If you are an owner of a corporation, that basically means you are a shareholder. You own stock in the company. So corporations have many owners, and they are referred to as shareholders. Now, if you have like a limited liability corporation where you're like the only owner, we just say you own all of the shares in your company. But generally, when we're talking about corporations, we're not talking about those types of businesses in the context of this lecture. Now, corporations have a little different protection when it comes to if the company goes bankrupt. They have limited liability for the firm. So in other words, let's say, for example, a corporation goes bankrupt, creditors cannot go after personal property. They can only go after the shares of stock. So owners experience limited liability. Again, they can only go after value of stock. So again, if I own stock in a company like Microsoft and they happen to go bankrupt, Microsoft can't come put a lien on my house. What they can do is freeze my stock and deplete the value of my stock. And then so that would kind of be a benefit of a corporation. However, a negative thing about a corporation is that it's subject to double taxation. So what that means is that the corporation pays out its resources, land, labor, and capital, and whatever's left over would be corporate profit, and that is supposed to be taxed at the corporate tax rate. Then whatever's left over is paid out to the shareholders in the form of dividends, and then shareholders have to claim that as personal income, and then they have to pay their personal income taxes on those dividends. So that's what we mean when we say that corporate income is taxed twice. Now, many corporations actually own and operate their producing units of their business in foreign countries. So when that occurs, we refer to them as a multinational business, or sometimes you'll just hear that the company has gone global. So most of your major corporations today are multinational businesses, and that is because there are financial incentives to being a multinational business. Not only tax incentives, which we're not going to go into in this chapter, but also just the ability to lower the cost of doing business. Oftentimes firms can produce their goods at lower costs by opening factories in countries other than the United States, so it can actually increase their profit margins. So again, if a company owns and operates producing units outside of the United States, they are considered a multinational business. Now, you'll recall when we talked about consumer spending, we referred to that as consumption spending. When we refer to business spending, we call that investment spending. So you have to kind of retrain your brain the way you think of the word investment, because normally when you think of investment, you think of, stocks, bonds, saving for retirement, things like that. However, in the context of this course, when we talk about business spending, we're talking about the money that businesses spend on capital goods in order to produce goods and services that consumers buy. So again, let's say I was a farmer here in Bakersfield and I had to buy a new tractor in order to continue to farm. That would be considered an investment expenditure, not a consumption expenditure, because I'm not using that tractor in my own personal life. I'm using it as a capital tool in the production process for my business. And when you see investment in a formula, we usually just write the letter I. So if you see the capital letter I in a formula, that is referring to investment expenditures. Now you'll also notice that I have a graph here showing investment expenditures over the same time period that I showed consumption expenditures. Recall when we looked at the graph for consumption expenditures, it just continued to increase as income increased. However, our investment expenditures are much more rocky, meaning that they're more volatile over time. And so just because income levels may be going up in the economy does not mean that businesses are necessarily spending more. Whether or not a firm is spending money on capital goods basically depends on the profitability of that investment and interest rates. In other words, interest rates, as they get lower, we tend to see investment expenditures increase. And then, of course, if the profitability of an investment increases, then you would also see an increasement in investment expenditures. Now, we don't necessarily buy all of our goods and services from U.S.-owned companies. We also buy goods and services from other countries, and so that is why we have to include the international sector into our analysis. Every single time we buy a good from another country, that's money flowing out of our country, but every time another country buys goods from us, that's money flowing into our country. So what I'm doing here is creating a simplified chart to give you an idea of how this impacts our domestic economy when we buy goods and services from foreign businesses and vice versa. So let's say hypothetically we only trade with two other countries. Let's say that we only trade with Mexico and Canada. And so let's say exports up here. And let's say, for example, that the U.S. exported $10 million worth of goods to Mexico last year and $15 million worth of goods to Canada last year. And then, of course, we would leave this blank because we don't export anything to ourselves. Let's say Mexico exported $7 million worth of goods to the United States, and they exported $14 million worth of goods to Canada. And then let's say Canada exported $3 million worth of goods to the U.S., and $13 million worth of goods to Mexico. So what we've done now is created these columns of data to illustrate the dollar value of the goods that we are exporting to other countries. Now remember in chapter 2 when we talked about trade, we were actually using examples where we were saying, you know, how much would Mexico trade with Canada for a car versus a plane? In the modern day market, we know that we're not trading goods for goods. We are, establishing dollar values for those goods and then purchasing the goods from the countries. So that's why that's what we're concerned with. We're not really concerned with what the actual goods are. We're just concerned with what the dollar value of the goods are that we're selling to other countries. Now you'll also notice that because I put it in a table like this, that's going to make it very easy for me to establish the value of the imports, because if it's an export for one country, that means it's an import for the other country. So again, we see the U.S. exported $10 million worth of goods to Mexico, which means Mexico imported $10 million worth of goods from us. And the reason why we're concerned with this is because we need to calculate something called net exports. Net exports is also sometimes in a formula, just see NX. And the formula for net exports is simply the value of a country's exports minus the value of a country's imports. And this is what will tell us whether you have money flowing into your economy or out of your market economy. So let's go ahead and calculate the net exports for the United States first. So in other words, we take the value of the U.S. exports. We exported $10 million to Mexico and $15 million to Canada. So we exported a total of $25 million worth of goods. And then we subtract out what we import. So we have to go across our column. We see we imported $7 million from Mexico and $3 million from Canada. So that means that we imported $10 million worth of goods. So $25 million minus $10 million, that would mean that we have a value of $15 million for our net exports. So because we sold more goods to the rest of the world than what the rest of the world sold to us, that means we have a trade surplus. Anytime the value of your net exports is positive, that means your country runs a trade surplus and more money is flowing into your economy than what is flowing out of your economy. Now we can do the same thing for Mexico now and see the opposite. So let's say we're looking at Mexico. We look at the value of their exports. So Mexico exported $7 million to the U.S. and $14 million to Canada. So they exported a total of $21 million worth of goods. And then we look across to see what is the value of what they imported. They imported $10 million from the U.S. and $13 million from Canada. So they exported a total of, they imported a total of $23 million. So 21 minus 23, we come up with negative $2 million. So the fact that we come up with a negative, that means that $2 million left Mexico's economy. In other words, they purchased $2 million more from the rest of the world than what the rest of the world purchased from them, which means they are running a trade deficit. Anytime a country runs a trade deficit, that means more money is leaving your economy than what is coming in. So again, if the value of your net exports is positive, you have a trade surplus. If the value of your net exports is negative, you have a trade deficit. Now, in the previous hypothetical example, I was showing how the U.S. had a trade surplus, but in reality, we actually run deficits every year. So here we can see a graph of our U.S. net exports going back to 1960 all the way up to 2010. And what you see is that our trade deficit has drastically grown over the years, especially marking, 1995 about is when they really started to increase. So that is when we started to drastically import much more from the rest of the world than what the rest of the world was purchasing from us. So again, in a macroeconomics course, and we would go into what are some of the factors that influence that. But for the context of this microeconomic course, you just need to know, the fact that the United States does consistently run deficits in our trade balance. So now that we've covered all the different components of the private sector, we can put them all together in what we call a circular flow diagram to illustrate how the income flows from sector to sector within a market economy. So of course, first we have our two primary components that we said was the households right here, and then of course the firms right here. And so we can see how money flows between these two components. You see the blue arrow on the bottom going from the households to the firms. That is us providing our land, labor, and capital to the firms, and in return they pay us for it. So that would be the yellow arrow going back into the households. And then of course the firms take those resources and produce goods and services. So again, you see the blue line on top going back into the households because we are paying for those goods and services. So that's illustrated by the yellow line going back into the firms. So again, the money's just flowing between the households and firms. We provide the resources, they pay us for those resources. The firms produce the goods, we pay them for those goods. Now, we don't necessarily spend all of our income on goods and services. You'll notice this top portion up here, which is basically the banking industry. So sometimes, we have a little money left over, we put that into savings into the banking institutions. And then what that allows the banks to do is loan that money out to the firms so that they are able to fund their investment expenditures. So that's what you see on the top portion here. Households putting money into the banking system then making loans to the firms so that they can fund their investment expenditures. So if we operated in a closed economy, those would be the only components that we would need to examine in terms of the flow of money. The money would just stay within our domestic economy. However, because we buy goods and services from the rest of the world, you'll notice that we have to include them also. And so that is the net exports you see down here at the bottom of the graph. In other words, U.S. firms will export their goods to foreign countries, and at the same time, U.S. firms will import goods from other countries. And then whether or not the value of your net exports is negative or positive tells you whether more money is flowing back into the domestic economy or whether money is flowing out of the domestic economy. So again, in the United States, we have money flowing out of our domestic economy going to the rest of the world because we consistently have negative net exports.